This one swing trading strategy that I'm about to share with you is extremely simple, but it could be the answer to your profitability. I'm going to be walking you through a step-by-step checklist that takes you through every stage of taking a profitable trade. On top of that, I'm going to be backtesting a live strategy with you so that you understand exactly how it works and how to trade it consistently. So let's dive straight into the video. Now, as you can see on the chart right now, these are actually the trades that we're going to be looking at that were available with this specific strategy in December. And I'm going to be going over to TradeZeller to start back testing this specific system and showing you step by step how this would have played out. So here in the top right hand corner, what you can see is the steps to this strategy. So very simple 5 steps. We're going to be going through them one by one and showing them how they apply to this market context. So Euro, US dollar, 4-hour time frame. Very, very important. So step 1, as you can quite clearly see, is higher time frame bias, right? HTF bias. That simply means understanding what's the bias of the higher time frame. By bias, we're referring to what's the likely directional intention for price. Is price most likely to trade higher, or is price most likely to trade lower? To do that, we're using very simple market structure. Essentially, we want to zoom out a little bit and understand the context of price in terms of where we have been going. So if we look at this delivery of price on the 4-hour time frame, it is very, very, very clear to see that price is aggressively bearish. So what we're going to do is we're going to take out our highlighter tool and we're going to zoom back in to understand, we have been aggressively bearish. Then we want to kind of refine that approach and look at structural levels. So you can see we have a swing down here, we have a swing up in here, right? So that makes for pretty much, swing low, swing high, swing low. So this is a lower low. So that's a break of structure. So we're bearish. We have a pullback in here, we continue bearish. We have a pullback in here, we continue bearish. And right now we're here. So we are neither above the high or below the low. That is our trading range. Very simple. That is how you define a trading range. Many traders make the mistake of not understanding where they should be trading because they don't understand how to build a bias. The way you simply build a bias is just understanding what's the directional intention for price. So if this was the low, this was the high, and then we break down and give a new low. And as of right now, price is high here, low here. We want to be trading with a swing trading strategy on this time frame in the direction of the overall trend in this scenario. So we want to trade in bearish, right? We want to be looking for sell positions. So our higher time frame bias equals bearish. Now what we're going to be looking for is premium and discount alignment. So simply put, our premium and discount is just literally take a fib, so the Fibonacci retracement tool, and you want to draw it from the high of the price leg to the low of the price leg. In this darker gray area, this is our premium and this is our discount. What does that mean? Anything above this 50% level after we break this low is premium. That is the area we want to be selling in. So it's very clear to see we are well inside of our premium. So as long as we're inside of our premium, we're good to move on to next step. Step number 3 is a lower time frame shift. So we have our directional bias, and essentially what we're looking for is a lower time frame shift. So when you're in this specific level of price, you want to be looking at the 15-minute time frame. Our 15-minute time frame is going to be the time frame we're using to enter the market. Now, if we look at the 15-minute time frame, what you will notice is we're actually pretty bullish. So we don't want to be looking to sell until this 15-minute time frame has shifted bearish along with the H4. Why is that important? Let's have a look at that theoretically. Imagine the 4-hour time frame looks like this, right? The 4-hour time frame is bearish. We put in a lower low, we had a pullback, we put in a new lower low, and then we have a pullback. That's what it looks like, right? We're operating, we had a low, lower high, lower low. Now we have swing low, swing high. We're in the premium, so the premium is about here. So above here, we want to be looking at selling. So what we're going to be seeing is as price comes down like this, the 15-minute time frame is going to be looking like this. And then as price starts to come back up on the 4-hour, the 15-minute is going to be looking bullish. But then when price gets into this level, we're waiting essentially for this 15-minute time frame to shift bearish. Because when this 15-minute time frame shifts bearish, the 4-hour time frame will start like this, right? And if we kind of put them next to each other, you'll see them. So the 4-hour starts to come back, the 15-minute shifts. And then the 15-minute can come back, that's when we're going to be looking at entering the market. That is our entry model. Essentially, we're just literally going to be looking at a 15-minute shift like this, and then an entry in here, and then start trading this trend as it trades down. What that's going to look like on the 4-hour time frame. The 4-hour time frame is pretty much going to be looking like this, all the way until ideally we take out this low down here. This low is going to be our target. This 4-hour low. Right, we're going to trade in the direction of that. The 4 hours is going to look like this, and the 15-minute time frame is going to be looking a lot more bearish. So let's take a look at what that kind of plays out on. Here we are, 15-minute time frame, and if we just zoom out, like really zoom out, we will see that our 4-hour, remember guys, we're trading based off the 4-hour. That was the low, that was the high, that was the low. So our 4-hour high is here, our 4-hour low is down here. So we want to be trading this move down here on the 15-minute time frame. And what we also want to be doing is as price starts moving down, right, we want to be getting in again. We want to be scaling into this trade idea. When you're a swing trader, you don't have a high quality setup that shows to you every day or even every other day. You have to capitalize on one big move, maybe in a few weeks, maybe in a few months. And you want to capitalize on that one big move and you want to scale into that position as much as possible. That's kind of what I'm going to be showing you in just a moment. Here we are, 15-minute time frame, right? And then I'm going to show you something very, very important now as this 15-minute time frame develops in New York session. So just for context, this blue box is Asia session. This green box is London session. This orange box is New York session. So this is New York session, Friday, 6th of December. And notice the price comes with a very, very aggressive run on price, run on this high, followed by a very aggressive sell-off. So this is NFP. NFP is known to be manipulative. That for another video. But if we go to the 4-hour time frame now, what we see is that was our swing high. And now we have aggressively manipulated that high. Please, please, please understand this. There is a huge difference between a break of structure and a liquidation. A liquidation is when you see price wicks above an old high and then closes back inside the range. The reason that's so important is because it shows us that the market doesn't agree that price should be above this high. Because if it did agree, then it would have closed above that high. At the market close on any time frame, that is the absolute agreed upon price by the market participants. So if price has attacked that high in a manipulation and then closed back down, right, inside of this range, below this low, the market has agreed that price should not be trading above that level. Then the next 4-hour candle, what happens? It gives us another aggressively bearish candle. This is a textbook sign of pretty much a stop hunt from this level so that smart money, right, large institutions are able to position themselves into the move in these regions, right, getting better averages on price because they're getting ready to move price lower, which is already clear in their bias. We've already got our higher time frame bias. Now it's about capitalizing on it. So if we go to the 15-minute time frame again and understand what has just happened, we've just had an aggressive manipulation, right? And then the aggressive sell-off. We've also created a fair value gap in this region. For those of you who don't know what fair value gap is yet, pretty much look at any 3 candles. So if we look at candle 1 here, candle 2 here, candle 3 here, if the high of candle 3 and the low of candle 1 do not meet, simply put, that is a fair value gap. It's essentially a liquidity void in that specific price leg. High probability that that area gets filled, providing you have context. But structurally, really and truly, what we want to be looking at is some kind of swing low to be broken. So for me, it's still not complete yet. The moment we get some kind of swing low broken like this, now that trade idea is complete. And now we have this newly formed fair value gap. So that is really what you want to be looking for, right? Which takes me on to step number 4, right? Which is a lower time frame entry model and kind of how we get into price. We've got a higher time frame bias that's bearish. We're in the premium and discount level. We've had now a lower time frame shift. Now we have a lower time frame entry model. Lower time frame entry model can be pretty much any run on liquidity into a fair value gap, into a order block, a breaker block, or even an inverse fair value gap. A run into any of those on this 15-minute time frame is what we're looking for. So as price begins to enter into the next day, Asia session getting ready to open, right? So there's Asia session. Now London session is getting ready to open. So what we have here is we have our textbook Asia session high, which for those of you who have watched me for long enough understand that's a void of liquidity. We have relative equal highs in here as well. Again, void of liquidity. And then in here we have a 1 hour order block on the supply range and a 15-minute fair value gap in here. So that's what we really want to be looking to trade. Want to be looking at putting an entry in here, so short, and then stop loss placement. Want to be looking at either A, the high, or B, honestly, the body of this candle. Because the reality is if price is going to come back and test the body of this, it's not a good sign. It's probably going to run the high. So from a risk to reward metric, you could be okay just covering the body of this specific high and kind of just trading this fair value gap. And then where do you want to be targeting? Now, your overall trade idea is based off of price running into the lows down here. This is our overall target, but sometimes price can go up, down, up, down, up, down. And so we also want to factor in the idea of being able to position ourselves and get out of our positions with partial profits. So looking for these little internal swing points, if price pulls back up into here, and then looking at this swing point down in here, looking to take a little bit of your position off in these little swing points, essentially is going to make sure that you're locking in profit and then leaving, you know, the other half or 60% of your position to run for these big kind of swing target levels. So if we drop into the 15-minute again to see how we kind of get in for our entry. So we're going to look at entering this position. I'm going to place an actual order. So we'll come over into here. We'll go 1% risk. If you're wondering what platform I'm currently using to actually be able to simulate what it's like in real time to trade, I'm using TradeZella. It's kind of the tool that I use to both backtest and journal all of my trades and review all of my performance. I'll leave a link in the description down below. You can kind of get yourself using this. Honestly, if you aren't using TradeZella or some kind of backtesting or journaling software, you're doing yourself a great disservice. 1% risk, we're going to be looking at, we'll put a stop loss and take profit. So for the overall position itself, we're going to place a stop loss up here, our sell limit down here. And then remember, our target is all the way down here, our 4-hour low. So our overall target down here is going to be this low, right? See, we're risking $2,000, 1% of a 200K account, which is pretty standard. If the trade comes through, it's $18,000 take profit. So that's the sell that we're looking at going for. We'll kind of close this for now. That's the sell limit placed. And then just play in price out. So London session opens with a manipulation of these Asia highs. Then we come into the lull of London, New York. New York session opens and then tagged inside of our New York window, right? Not inside of our specific kill zone, but this is a tag at 11:15 a.m. Eastern Standard Time. That's our first position. So after this, essentially, you can see price continues running out. I'm going to remove this for now. You can see that we're tagged into that position. We have down here our unrealized P&L. So currently running up $2,500 in profit on this position. We'll keep it running. We're heading into tomorrow. So again, important to understand what's happening now contextually. Asia session is forming again. So we're still bearish. We're still expecting price to trade lower. So this is how you can start scaling into your swing positions. As a swing trader, you don't have all of these opportunities present consistently. So when you get in on a right move at the top of a price leg on the higher time frame, you want to be looking at getting in as many positions as possible on that ride down, but you have to do it very intentionally and very smart. And so here's what you should do. Essentially what you want to be looking at is, you can see that price puts in this lower leg, comes back, pushes in. We come temporarily bullish whilst we look at coming to tag in this position, mitigating the fair value gap and highs of NFP. And then what happens? Well, price expands higher, we create a high, we pull back, we create a higher low, right? This high is higher than the previous low. Then we go higher high, we tag in, and then we give a change of character. So here we shift from internally bullish to bearish. That is our sign that this high is in control of the market. At this point, the assumption is if price is going to continue lower, it is going to do so whilst respecting this high. If price is going to be heading back above this high, the likelihood is it's also going to be heading above this high. With that information, we can make an informed decision. What I would look at doing is, how can I get into this market? Before I do that is, how can I reduce risk that I'm already exposed in? So I have currently, $2,000 worth of risk exposure. What I want to do is I want to bring that risk down to here. I am now going to put my stop loss above this high because If price breaks above this high, the likelihood is it's going to be heading for this high. That's what probability would indicate. So I can reduce this risk to 350, which then allows me to do what? It allows me to add a new layer of risk, another trade, without doubling my total risk exposure. I still have the opportunity to make $18,000 off this trade that's open. This target is still $18,000. So I'm still running in that position. But what I want to do is look at getting myself scaled in to this position because we have shifted market structure. So we have Asia session high. And for those of you who know me, understand the importance of this Asia session high and the manipulation therein, right? We have this entire pretty much, buy to sell range. I don't want to fuss over exactly where I need to get into price in here. There's no real fair value gaps. It's all mitigated price action. So pretty much what I want to do is I want to wait for London session to come in and look at, can we get a reaction from London session? So you can see this is Frankfurt. Now there's 1 a.m. Now we've manipulated Asia high. So we're in play with the manipulation of Asia high. When London opens, we want to be looking at a bearish reaction at London open, and then we're good to go. Usually what I would like to see is London sweep this high. But if Frankfurt has done it, the job has been done. So now it's 1:30, and there we have London open. So you can see London opens with an aggressive bearish M15 candle off the back of sweeping this Asia session high. So what we want to be looking at is how can we get involved in another short position? That's the confirmation, but still we don't know whether price could come back up in here. So I don't want to sell here, put my stop loss here. I still want to be protected. For me personally, I would rather have a larger stop size and a lower overall risk to reward, but have a higher likelihood of staying in the position as opposed to being overly aggressive on risk and expectation of risk to reward when it doesn't really make sense. So how can we get ourselves involved? Well, this is the logical high for price that I expect to be respected. This is where we currently are for price. So if I can just get involved and the risk to reward makes sense, and the risk to reward on something like that is, almost a 1-to-7 risk to reward. It's a no-brainer. The risk to reward is there. Can we look at scaling into this position? We can create a new order, advanced, we'll go 1% of initial balance. So an extra $2,000 worth of risk is what I'm willing to spend here. My stop loss goes here. So now if I place this trade, I have a total of $2,300 of risk exposed. But if price hits my target, or at least some of my target profits, I stand to make for this specific position. That's the first position. The second position would be an extra $13,000. So I've added basically a total of $347 of total risk to this position in exchange for potentially an extra $13,000 if things play out. That to me makes sense. I've adjusted my risk. I still have open pretty much the total one lot of risk, $2,347 of risk. That to me is pretty much 1% total risk. But I stand to make the 18,000 and the 13,000. So a 9% move and a 6.5% move. And I still have only my 1%, give or take, my 1.2% worth of risk open. That is how you want to be managing risk, not just forcing yourself into price. So we can remove this for now. Now we're in 2 open positions and we can just essentially watch and see how price reacts to these levels. We immediately start running in profit. And honestly, this is an area in which I would be looking at securing something or at least moving my stops to break even if I hadn't taken anything off the table. And again, you're swing trading. You're not actively watching these positions play out. You're allowing them to unfold. You're checking in day by day. New York session presented nothing. Now we come in to the next day. So here we have Asia session again. And honestly, you can look at continuing to position yourself in this market. The London session begins. Now, why can't we continue to get ourselves involved in this market? We stand to be able to position ourselves again into price with a sweep of Asia session high, right? Which is the classic sweep reversal, sweep reversal, sweep reversal. With the sweep of Asia session high, we can look at getting involved in price. London session doesn't give us the pullback. If we can get above here, I'll be looking at selling. And we don't, we get the continued momentum. And then London finishes. Now New York opens again. Now what we have is new structural levels, right? Because we had price puts in a low, we have a pullback, we get a new lower low. Usually I would sell this high, but because it's Asia, I'm not interested. So usually if this wasn't Asia session, I would be looking at selling above this London session, but because it's Asia, I'm not interested. You can see we respect Asia in this instance, which doesn't happen most times. I don't mind not taking a trade just because it plays out once or twice doesn't mean it will continuously play out. So for me, that's a no-go, taking a trade like that. But now we have a new high, right? We've taken these lows. Well, in all fairness, we actually only have manipulated them. So we still haven't created a new high yet until we can break them and confirm the break. Now we can. So now we've broken structure. So now we've broken the lows and now we have new structure. Now we do have equal highs in here, but if we kind of allow ourselves to come to Asia session next day, right? We're getting ready for the London session open. This for me is a textbook setup, what we're about to see. So now we start heading open. There's London open. Now what I want to be doing is I want to be getting involved again. I want to be scaling into my positions. We have swing high to swing low. We do have relative equal highs. So I don't want to be moving my stops above that Asia session high because it is possible to get manipulated, but we're kind of playing with the strength of overall price. I want to be getting involved in this supply zone in here. I'm going to put my stops above the highs in here, which yes, it is risky in all honesty, but nonetheless, just playing out the edge. If Asia wants to be respected, occasionally it can be. And just looking at pretty much just playing ourselves back in, right? So again, that would be a high risk reward trade and we want to get ourselves back in for this price. So another order comes in. We're going to go initial balance 1% and we're going to go stop because I actually got myself in a little bit too late. Imagine we've already been tagged into this position. So in here, if this gets traded through, we would have got tagged at this level. That's where I would be getting in. My stop loss would be going above Asia high. Again, not a great place for a stop loss, to be totally honest with you. But for the context, I just want to show you the strategy. I don't want to do discretion for you guys because discretion is something that you'll have to learn in greater detail. It's not something that I can just teach you in a 30-minute YouTube video, right? Discretion is something that you need to understand contextually. It's something that I have to teach day in and day out for you to start understanding context. If that's something that you would be looking for, i.e. me walking you through price every single day, twice a day, exactly what I'm looking for, that is actually something that I do with all of my students inside of my inner circle. And that's actually one of the main things that enabled Ralph, one of our top students, to make over $50,000 with FTMO in the last 3 months of this specific year. If that's something that you think would help you, then down below in the description, I've left a link for you to check a little bit more about that out. But let's get back to the video. So we'll just place this trade and we'll take it regardless. So that's open now. If price pretty much trades through that level. So there you go. We would be executed into this position. We have an extra $2,000 worth of risk up here, but we have an extra $20,000 worth of profits to take down here. So now we have a total of $4,350 worth of total risk exposure available. I wouldn't move these stop losses above here because it's possible that these highs get manipulated given the context, but we'll keep moving. So what we see here is, again, another position. See how price plays out. Price starts moving in our desired direction. That's pretty solid, right? Again, we don't break this low. If we can break this low, we can look at scaling back in. Sometimes price does respect Asia high, right? Something you have to understand. But now what we're doing is we are building a lot of buy side above these highs, objectively speaking. But what I will say is we have now broken those lows. So in London session, in New York session, sorry, again, we could be looking at getting ourselves back in the market in this level. The problem is we're already in a position in this level and the risk is still open. Therefore, it doesn't make sense to do so. So we just literally play price out as it is. You can see very, very beautiful respect of this level. Again, like I said, if I wasn't already in a position from this level with my stop loss open, I would definitely be selling from this level. But because I'm already in a position at this level with my stop loss still open, it doesn't make sense. I'm just doubling down my risk on the same trade idea technically. Therefore, it doesn't make any sense. And so again, there's a stack of liquidity above these highs, but we're having a very, very nice reaction. We currently have, $19,000 of open profit. What we can do now is we can move this stop loss. So we currently have $4,350 worth of risk on the table. And this $2,000 worth of risk here can be moved pretty much to break even. So the initial entry is in here.
What we really want to be looking at doing is understanding price comes back up to here, trades out the low, pulls back, and then trades out the low again. And so by moving our stops to this level, that's pretty much a break-even level. So we remove the risk entirely from that one. So now we have just $2,350 worth of risk open. And the reason I'm keeping the stop losses up here for this specific position is because of this arc of liquidity that is building up. We have 1, 2, 3, 4 session highs, plus this is high of Tuesday, high of Wednesday, high of Thursday. The likelihood is that is getting ran for liquidity when you understand context. But again, for the purpose of this, we're just repeating strategy. We keep playing price out. Another day passes. You can see price comes and respects that level. So we're still not taken out at break even from that price. Next day, what happens? Asia session is opening. Again, no real way for us to kind of scale into this position. And then we get tagged out at break even. So out of that position. And then price begins to trade out of that level, which is totally fine. What are we doing though? More liquidity being built across these highs. And what I want to do in context is I want to see if we can get some kind of run into this pocket of liquidity and a bearish reaction. That's when I want to execute another position, because I want to scale into this trade idea. If we look at the 4-hour time frame, remember our overall trade is based off of this price action. We're expecting a new lower low. So as price comes down, we're just scaling in the highs. And the purpose is to catch these highs. We want to be catching these highs as price expands down. When it comes back and then starts moving again, we want to be catching these highs to scale into this overall move. That is the overall idea, especially when you're a swing trader. You don't get these opportunities to get involved like this every week. You know, it can take a month for a great setup like this to occur. So when you get into that leg of price, that trend, you want to be executing like crazy, versus when you're a scalper, you can be in and out of positions, you know, every day. You don't need to be trying to force yourself into one price leg. So we'll continue playing price out. There we go. There's through the weekend, back into Monday. Market open. Again, what have we created here? More liquidity. We have Asia high with a New York high, with a London high, with a New York high, with an Asia high. This is a crazy amount of liquidity that's building up in this area of price. If we can manipulate this and then sell off, that is the setup of the week. London opens. London gives a really nice liquidation of this high, but still stacking for that overall liquidity, right? Still stacking. For me personally, that's still a breach on liquidity. In the moment, you may feel like you missed out on taking that type of position. But again, price is building up liquidity at these highs. This is a very shallow sweep. For me, that's still high of day, high of day, high of day, high of day, high of day. I want to see a real sweep into that area. Like that, there's an Asia just before Asia. Then you get a sweep. Now we're talking, because now what we've done is we've run into 1 high, 2 highs, 3 highs, 4 highs, and their high of days. Super liquid areas of price just before Asia session, just before that Asia session begins, and then Asia starts to sell off. Now we can look at getting involved inside of London session. So here we can see London session opens. And we can see that, again, we want to be looking at these little internal market structure shifts. So push up, pull back, push up, pull back, push up, pull back. That's a shift. So that right there is where you can understand that price has shifted. And we could be looking at getting ourselves involved in some more sells with the right level of confirmation. I'm not a huge fan of trying to sell when Asia high is still open, but because of context, it makes sense. So now we can see that London begins to sell off. There's still no setup for me in this specific price region, but as New York opens, now what I can do is I can look at a manipulation of London high as my entry. So manipulation of London high, and then I can use this high here to protect. I can use the open of that high to protect that position. And if I kind of zoom out, what's the risk to reward like on a position like that? Still makes sense? Absolutely. Now we can look at getting ourselves back involved in price. 1% of initial balance. So we're going with $2,000 risk. Our stop loss we're going to put in here. In fact, we'll put it just above the Asia high. The take profit level, we're going to put down here $40,000 worth of profit potential for an extra $2,000 worth of risk. And we're still running in these profitable positions as well. So that's the limit that we're essentially going with. We can remove it now because that trade is open. And we can look at if we can get involved in the high of that level getting breached. There's your entry. That puts this stop loss in play. And then we begin selling off with not the hugest amount of momentum, but really nice sweep of London. Again, all playing on the idea and understanding of intraday liquidity. London session, really nice. But for me, there's no way to scale in because I'm scaling on the same trade idea. So for me, it just doesn't make sense. A really nice liquidity. If we come into the next day, and then we get a huge amount of sell-off. Now at this point, now we can look at our stop levels and begin positioning and managing them. So what we can do is we can bring this stop loss down to here because price should not be running past this swing high now. We can be looking at this stop loss down into here. So they're now locked in for profit as well. So we have pretty much no risk on the table, zero. Everything now is essentially upside. And we want to see where's our overall take profit levels. They're down here. So let's kind of see how the rest of price plays out. You can see price comes to this level, but does actually respect it. We have a reaction. We create somewhat equal lows in here. Again, fail to take it. We end up pulling back all the way in here. Still, for me personally, we're in the middle of no man's land. For me to get back involved in shorts, I need to see price at least coming back into somewhat of this range. Otherwise, I'm just trading inside of no man's land. And now we're inside of the weekend. And this, for me, is just a bunch of noise. There's nothing actually available in this price leg, neither wins or losses. Price is pretty much reacting from nothing. I wouldn't be interested until we get a reaction into here, which only comes in here, and then there was no entry off the back of that. And this is also understanding that this is the end of the year. So end the second half of December, if you know price action, you understand that the second half of December is always this choppy. And then eventually we do end up running straight through our profit target, and all of those positions essentially are able to close themselves.